What if I told you that the financial system you were born into, the one your parents trusted, the one your teachers told you to believe in, the one that decides your salary, your savings, your mortgage, your retirement, has already changed, not gradually, not slightly, forever. And most people have absolutely no idea it happened. Because the biggest financial revolutions in history don't arrive with sirens. They don't interrupt your Netflix. They don't crash your banking app overnight. They happen quietly in policy rooms, in central bank meetings, in emergency liquidity facilities, in digital code, in bond markets no one under 40 ever checks. And by the time the headlines catch up, the game is already different. For over 50 years, the global financial system ran on a simple but powerful foundation. Trust the dollar, trust the banks, trust the system. After 1971, when the U.S. left the gold standard, money became fully fiat. That meant currency wasn't backed by gold, it was backed by confidence. And that confidence was backed by the strength of the U.S. economy, military dominance, global trade agreements, and deep capital markets. It worked. For decades, the U.S. dollar became the world's reserve currency. Oil was priced in dollars. International trade was settled in dollars. Countries held trillions in U.S. Treasury bonds. If there was a crisis anywhere in the world, capital didn't flee the dollar. It ran toward it. The system wasn't perfect. It inflated, it crashed, it created bubbles. But it always stabilized until something fundamental began to shift. The first crack wasn't dramatic, it was structural. In 2008, the global financial crisis exposed a dangerous truth. The entire financial system was leveraged to the edge. Mortgage-backed securities, derivatives, shadow banking networks, interbank lending exposures, everything was interconnected. When Lehman Brothers collapsed, it wasn't just one bank failing. It was a signal that the system itself was fragile. Central banks responded with something unprecedented: quantitative easing. They didn't just lower interest rates, they created money, digitally. Trillions of dollars were injected into the system to buy government bonds and financial assets. The Federal Reserve's balance sheet exploded. The European Central Bank followed. The Bank of Japan went even further. And here's what most people missed. That moment changed the relationship between governments, central banks, and financial markets forever. Before 2008, markets were supposed to discipline governments. After 2008, central banks began disciplining markets. Every time volatility spiked, liquidity arrived. Every time credit markets froze, emergency facilities appeared. Every time asset prices fell too far, policy turned accommodative. Investors learned something powerful: don't fight the Fed. That phrase became more than advice, it became doctrine. Asset prices climbed, stocks recovered, real estate surged, bonds entered a multi-decade bull market, and those who owned assets saw their wealth expand dramatically. But underneath the surface, something deeper was happening. The system was becoming dependent on intervention. Interest rates stayed near zero, not for months, but for years, then for over a decade. Debt became cheaper than ever before. Corporations borrowed aggressively. Governments ran persistent deficits. Consumers refinanced and leveraged. Global debt didn't shrink after the crisis. It exploded. According to international financial data, total global debt surged past $300 trillion. Governments borrowed. Corporations borrowed. Households borrowed. The entire system became more leveraged than it was before the crisis that nearly broke it. Why? Because low rates made debt manageable. As long as borrowing costs stayed low, the system could function. Growth could be stimulated, markets could rise. But this created a new vulnerability. The entire financial system became extremely sensitive to interest rates. And then 2020 happened. The pandemic wasn't just a health crisis, it was an economic shutdown of historic proportions. Entire industries halted overnight, supply chains fractured, travel collapsed. Small businesses closed en masse, markets crashed in weeks, and central banks responded even more aggressively than in 2008. Trillions more were created, stimulus checks were distributed, corporate bonds were purchased, even junk bond ETFs received support. The Federal Reserve's balance sheet went vertical. Governments worldwide ran the largest peacetime deficits in history. For a moment, it looked like total collapse. Instead, asset prices soared. Stocks hit new highs. Housing markets went parabolic. Cryptocurrencies exploded, speculative assets reached extreme valuations, liquidity flooded the system at levels never seen before. But liquidity has consequences. When you inject trillions into an economy while supply chains are constrained, prices don't stay stable. Inflation returned, not the mild 2% inflation policymakers had targeted for years, but the highest inflation rates in 4 decades. Food prices surged, energy prices spiked, rent climbed, everyday living costs rose faster than wages, and suddenly the central banks faced a dilemma they hadn't encountered in years. To fight inflation, they had to raise interest rates. But raising rates in a system drowning in debt is dangerous, yet they did it anyway. The fastest rate hiking cycle in modern history began. Rates went from near zero to levels not seen since before the 2008 crisis. Bond yields surged, mortgage rates doubled, financing costs spiked for corporations and governments alike. And here is where the real transformation begins. For decades, bonds were considered the safe asset. When stocks fell, bonds rose. A balanced portfolio relied on this inverse relationship. But in this new environment, both stocks and bonds fell together. The so-called risk-free asset was no longer risk-free. Bond markets experienced historic losses. Pension funds faced stress. Regional banks, loaded with low-yield bonds purchased during the zero-rate era, suddenly faced unrealized losses as rates rose. Then something else broke. Several regional banks collapsed, not because of reckless subprime lending, but because of interest rate risk. They had bought long-term bonds when yields were low. As rates rose, the value of those bonds plummeted. Depositors panicked. Withdrawals surged. Liquidity vanished. And once again, emergency facilities appeared. The system survived. But the message was clear. The financial architecture built during the zero-rate era was incompatible with higher rates. This is the moment the shift became undeniable. For decades, the world operated under a monetary regime of falling rates, expanding globalization, and increasing dollar dominance. Now we are in a regime of higher structural inflation, geopolitical fragmentation, rising debt burdens, and digital financial transformation. Let's talk about geopolitics. For years, globalization reduced costs. Supply chains stretched across continents. Manufacturing optimized for efficiency. Capital flowed freely, but geopolitical tensions changed that. Trade wars intensified, sanctions became financial weapons, countries began reconsidering their reliance on the US dollar. When reserves can be frozen, currencies can be weaponized, and payment systems can be restricted, nations begin seeking alternatives. We are now seeing bilateral trade agreements settled in local currencies. Gold purchases by central banks have surged. Discussions around alternative payment rails are accelerating. Is the dollar collapsing tomorrow? No. But the unquestioned dominance of a single reserve currency is being reconsidered in real time. That is historic. Meanwhile, technology is reshaping finance from another direction. Digital payment systems are replacing cash. Fintech platforms are competing with traditional banks. Blockchain-based systems are offering decentralized alternatives. Central banks are actively exploring digital currencies. Central bank digital currencies, or CBDCs, represent a fundamental redesign of money itself. Imagine programmable money. Money that can be distributed instantly. Money that can carry conditions. Money that bypasses traditional banking intermediaries. This isn't science fiction. Pilot programs are already underway in multiple major economies. If implemented broadly, CBDCs could transform how stimulus is delivered, how taxes are collected, how cross-border payments occur, and how monetary policy is transmitted. The plumbing of finance is being rebuilt. At the same time, artificial intelligence is entering capital markets. Algorithmic trading already dominates volume. AI-driven risk models are evolving rapidly. Credit decisions are increasingly automated. Portfolio management is being reshaped by machine learning. The speed of financial decision-making is accelerating beyond human scale. Combine this with social media-driven market behavior, and you get volatility regimes that look nothing like the past. Short squeezes, meme stock frenzies, retail-driven momentum waves. The structure of participation has changed, but perhaps the most important shift of all is psychological. For decades, the implicit belief was that central banks would always stabilize markets, that asset prices would recover. that buying the dip was a reliable strategy. Now, policymakers are balancing inflation control against financial stability. They cannot always cut rates at the first sign of trouble. They cannot always flood markets with liquidity without reigniting inflation. The central bank put is no longer guaranteed at the same strike price. And that changes investor behavior. It changes portfolio construction. It changes risk tolerance. It changes capital allocation decisions globally. The cost of capital is no longer artificially suppressed. And when the cost of capital rises, everything reprices. Growth stocks, private equity valuations, venture capital funding, commercial real estate, government budgets. In a low-rate world, future cash flows are worth more today. In a higher-rate world, those same cash flows are discounted more heavily. Entire business models built on cheap capital are being stress-tested. This is not a normal cycle. This is a regime change. A regime where debt levels are historically high, rates are structurally higher than the last decade, geopolitical risk is elevated, and digital transformation is accelerating. And when regimes change, strategies that worked for 20 years can stop working almost overnight. The 60-40 portfolio is being questioned. Passive investing assumptions are being tested. Liquidity is no longer infinite. At the sovereign level, governments face rising interest expenses. As debt rolls over at higher yields, budget pressures increase. Fiscal dominance becomes a concern. Will central banks be pressured to keep rates low to help governments finance debt? Or will they maintain independence to fight inflation? That tension will define the next decade. Meanwhile, demographics are shifting. Aging populations and developed economies strain pension systems. Fewer workers support more retirees. Productivity must rise, or standards of living decline. Technology may solve part of that equation, but transitions are rarely smooth. The financial system is not collapsing. It is transforming. Quietly, structurally, permanently. And the people who recognize that early will position themselves differently. They will think differently about debt, about cash, about diversification, about global exposure, about digital assets, about geopolitical risk, because the rules of the game have changed, and most people are still playing by the old ones. If you step back and look at the system from 30,000 feet, what becomes clear is this: the era of predictable macroeconomic patterns is over. For nearly 4 decades, investors operated in what many now call the Great Moderation. Inflation was relatively stable, interest rates trended downward, global trade expanded, supply chains optimized for efficiency over resilience. Capital was cheap, liquidity was abundant, and every major crisis was eventually met with easier monetary policy. That environment created certain habits: buy growth, buy index funds, leverage cheap debt, stretch valuations, assume globalization lowers costs, expect central banks to step in. Those habits were rational in that regime. But in a structurally different regime, the same habits can become vulnerabilities. Let's talk about inflation more deeply, because inflation is not just a temporary spike in prices. It is a signal of imbalance between supply and demand, between money and goods, between policy and productivity. For years, inflation remained subdued despite massive monetary expansion. Why? Because globalization exported deflation, cheap labor, outsourced manufacturing, technological efficiency, just-in-time logistics. Every time domestic wages tried to rise, companies moved production elsewhere. But when global supply chains fracture, when countries reshore production, when energy systems are restructured, costs rise structurally. Energy is foundational to everything. When energy prices rise, transportation costs rise, manufacturing costs rise, food costs rise, housing costs rise, inflation becomes embedded. At the same time, labor markets in many developed countries are tight. Demographic aging reduces the supply of workers. Immigration policies shift. Skill mismatches increase. Wages begin to rise not just cyclically, but structurally. And once wage inflation becomes embedded, central banks face an even more difficult battle. Because fighting inflation aggressively risks recession, but failing to fight it risks currency devaluation and long-term instability. This balancing act is redefining monetary policy. Central banks are no longer just stimulating growth. They are navigating credibility. If markets believe inflation will remain high, long-term bond yields rise. If long-term yields rise too quickly, financial conditions tighten abruptly. That can trigger instability in housing markets, equity markets, and credit markets simultaneously. We are seeing signs of that tension already. Mortgage affordability has deteriorated sharply. Higher rates mean higher monthly payments. Housing markets slow. Construction slows. Consumer confidence weakens. Commercial real estate faces a different but equally serious challenge. Office demand has shifted due to remote and hybrid work. At the same time, higher rates reduce property valuations. Loans taken out at low rates must be refinanced at higher ones. That squeezes cash flows and increases default risk. Regional banks are deeply intertwined with commercial real estate lending. That creates feedback loops. And this is how systemic risk evolves, not from one dramatic collapse, but from layers of interconnected stress. Now consider sovereign debt. Many governments dramatically increased borrowing during the pandemic. That debt must be serviced. When rates were near zero, interest payments were manageable. But as yields rise, the cost of rolling over debt increases. Some nations face difficult choices: cut spending, raise taxes, inflate away debt, or risk fiscal instability. In emerging markets, the situation can be even more delicate. Many borrowed in dollars. If the dollar strengthens and domestic currencies weaken, debt burdens rise further. This is why currency volatility is increasing. We are witnessing subtle shifts in global capital flows. Countries are diversifying reserves. Gold accumulation by central banks has accelerated. Bilateral trade agreements increasingly settle outside traditional dollar channels. Again, this does not mean immediate collapse of the dollar. It means gradual diversification, and gradual diversification changes capital allocation patterns over time. Now layer technology on top of this. Financial infrastructure is being digitized at an unprecedented pace. Real-time payment systems are replacing slow settlement networks. Peer-to-peer platforms challenge traditional intermediaries. Decentralized finance experiments with trustless systems. Tokenization promises fractional ownership of real-world assets. Tokenized bonds, tokenized real estate, tokenized commodities. If assets become programmable and instantly transferable across borders, liquidity patterns change dramatically. Settlement times shrink. Counterparty risk changes. Intermediary roles evolve. At the same time, regulatory frameworks are struggling to keep pace. Governments want innovation, but they also want control. They want efficiency, but they fear instability. They want digital currencies, but they worry about privacy. Central bank digital currencies could redefine the banking system itself. Today, commercial banks create money through lending. Deposits form the base of that system. But if individuals can hold digital currency directly with the central bank, what happens to commercial bank deposits? In times of stress, money could flow instantly from private banks into central bank accounts. Bank runs become digital, faster, more severe. To counteract that, policymakers would need new safeguards. This is not just an upgrade of payment apps. This is a redesign of the monetary transmission mechanism. Now consider artificial intelligence in credit allocation. AI can analyze thousands of variables in milliseconds. It can price risk dynamically. It can adjust lending standards based on real-time data. That increases efficiency, but it also increases speed. And speed amplifies volatility. If algorithms simultaneously de-risk portfolios based on the same signals, liquidity can vanish quickly. We have already seen flash crashes. We have already seen liquidity vacuums in bond markets. We have already seen volatility spikes driven by automated strategies. As financial markets become more automated, stability depends increasingly on code. And code follows logic, not emotion. But markets are human systems at their core. When fear spreads, behavior shifts. Now let's talk about wealth inequality, because it is deeply connected to this transformation. The era of ultra-low interest rates inflated asset prices dramatically. Those who owned stocks, real estate, private equity, and venture capital saw enormous gains. Those who relied solely on wages did not benefit equally. Asset inflation widened the wealth gap. When central banks expand balance sheets, they don't distribute assets evenly. Liquidity flows into financial markets first. It raises valuations. Now, in a higher rate world, asset price growth may slow, but the inequality embedded during the previous decade remains. Political pressure increases, fiscal redistribution becomes more debated, tax policy becomes more contentious, and fiscal policy is becoming more active than monetary policy. Governments are investing heavily in industrial policy, energy transitions, semiconductor manufacturing, infrastructure renewal. That marks another regime shift. For decades, market forces dominated capital allocation. Now governments are strategically directing capital toward national priorities. Energy independence, supply chain resilience, technological sovereignty. This changes which sectors attract funding, which industries receive subsidies, which regions experience growth. Capitalism itself is evolving from hyper-global efficiency toward strategic resilience, and resilience is more expensive than efficiency. That cost is embedded in the system. Meanwhile, retail investors have entered markets in record numbers. Commission-free trading apps democratized access. Social media created decentralized information networks. Financial narratives now spread virally. Market psychology moves faster. Information asymmetry shrinks. But misinformation spreads equally fast. Volatility regimes adapt to this new participation layer. Now zoom out further. The financial system used to revolve around a few core pillars: banks, bond markets, equity markets, and central banks. Today, it also includes shadow banking networks, private credit funds, sovereign wealth funds, algorithmic liquidity providers, crypto ecosystems, fintech payment giants.